When you're applying for an occupational license, you're going to have to satisfy some amount of financial security by either purchasing a surety bond or a letter of credit. But which should you choose? Both serve the same purpose of ensuring that you're going to do your job duties and follow the law and regulations and also just not commit fraud against your customers. And both have the same amount of financial security. Let's start with the cost to get each. So a letter of credit is obtained from a bank. Essentially, the bank is extending their credit to guarantee an amount in a particular account. And when you actually go get a letter of credit, your personal credit is almost always going to be a factor. So if you don't have great credit or just even average credit, the bank is going to most likely always require you to fund this account by either say 50%, 75%, or a lot of times 100%. So that means you're going to have to pay your own money to fund this account. If you have excellent credit and really good experience, it is possible that the bank would extend the credit and fund the account themselves, and you don't have to come out of pocket for anything. It's rare, but it does happen. So for surety bonds, a surety bond is purchased from a surety. This is just the insurance company that's going to underwrite the type of surety bond that you're going after. And for 50% or about 50% of all the surety bonds out there, we can get you pricing with no credit check required, which is great. But the other 50%, your personal credit will also be a factor. So the good news is, even with poor or limited credit, as long as you get approved, your high rate for purchasing your surety bond is going to be like about 5%. If you have excellent credit, you're looking at 1%. Average credit, you're probably looking at 2 to 3%. So bottom line, in nearly every case, getting a surety bond is going to be significantly less expensive to actually initially get. Let's talk about maintaining each. So with a letter of credit, as long as you don't have any claims during your course of business, the amount of money that you paid to fund the account, that's just going to remain in the account for as long as you're in business. And for a surety bond, you're going to have to renew it every 1 to 3 years. But the good news is, when you do renew it, it's for that fractional amount. So while a letter of credit really doesn't cost you more over the years, it's because of the initial investment being so large, a surety bond actually ends up being a better deal over the long run. Finally, what if a claim is made against you? So with a letter of credit, if a claim is made against you, it's really dependent upon how the bank is going to handle that claim. They might do an investigation themselves. Maybe they might hire an outside agency. It really kind of depends. And because surety bonds are underwritten by an insurance company, if a claim is made against you, you get the insurance company's entire claims department behind you to investigate the claim and make sure that it's legitimate. So which should you choose? So if you have excellent credit and good experience, definitely look into getting a letter of credit. It might be the best way to go. However, in most cases, getting a surety bond is going to be much less expensive to purchase and maintain going forward. We're Surety Bonds Direct. We're a specialized surety agency, and it's our job to help you find the lowest possible price for your surety bond if you choose that route. Click on the link in the description. You can go learn more and get your pricing. If you have any questions, ask in the comments, and I'm going to answer you.